So in the last recording, we looked at the responsibility report, the performance report for this profit center, and we could see this manager would be evaluated on the segment margin. And so the segment margin exceeds, right? We've got a favorable variance for the segment margin. So we would overall evaluate this manager favorably. We can see the direct fixed costs. There's a favorable variance here. The sales revenue, there's a favorable variance, and so we would expect the variable cost to be higher than budgeted because the sales revenue was higher than budgeted. So overall, we would give this manager, a good performance evaluation. So next we want to take a look at evaluating the manager of an investment center. And so the investment center, we said, not only has to generate revenue, control costs, but this manager would be in charge of managing the assets of the investment center. So the performance for this manager, we would calculate return on investment, ROI, or residual income. So ROI, we calculated this when we talked about our pricing. The return on assets was a certain percentage of the assets. And so the way we can calculate the percentage that was earned, we take the operating income and divide it by the total assets. And so the manager is probably given a target ROI, and then their bonus is going to be based on whether or not they achieved that ROI. So sometimes, though, the ROI is going to cause a conflict between the manager's goals and the goals of the business, because we said the manager's given a target ROI. If that manager has been doing well with their branch and they have exceeded the target ROI, they may turn down a project that meets the required ROI if it's less than what they're currently achieving, because even though it meets the target ROI, if it's less than what they're achieving, it's going to bring down the overall ROI. So a manager may turn down a project that the investors would want the manager to take because the manager doesn't want the ROI that they're currently achieving to be reduced. So that's why residual income could be a better measure. So ROI is the difference between the operating income and the minimum acceptable income, which is the target rate of return. So that minimum percentage times, or that required percentage times the total assets. And so if this is the case, once they have met the minimum acceptable income, that manager would be willing to take on any project that is going to increase the operating income, because that's going to make the residual income higher. And so this is going to maybe be a better measure for achieving goal congruence between the manager and the business strategy. So let's take a look at an example. So here we have two divisions, and they have a target rate of return of 20%. So the ROI, we know, is calculated by taking the operating income and dividing it by the total assets. So for Division 1, the operating income divided by the total assets comes to 26%, and let's go out a couple of decimal places. 25.94. We do the same thing for Division 2, divide the operating income by the total assets. That comes to 18.95. So we can see Division 1, they're exceeding the 20%. Division 2, that manager's wanting to get to the 20%. So the residual income, we take the operating income and we subtract the minimum acceptable. Okay. So we've got the operating income for each division, and the minimum acceptable income is going to be the 20% times the total assets. So then we can just subtract. And we can see the residual income is 870. We can see residual income is negative 102 because this manager is not currently achieving the 20% ROI. So now let's take a look at a further scenario. So let's say that they have the opportunity to invest in a project where they'll have to invest $4,000 in assets, but they'll get an operating income of $850. Well, what's the ROI going to be there? Well, we'll divide. Whoops. So we're going to take the operating income and divide it by the assets. So the ROI in this project is over the 20%. So this would be a project that the investors would want the managers to take. If they're being evaluated on ROI, are both the managers going to want to take the project? Well, Division 2 definitely, because they want to improve their operating income. But let's take a look at what's the ROI of each division if the investment is made. Well, so now the new operating income for Division 1. Division 1 had operating income of $3,800. If they make this investment, they'll have an additional $850 in operating income. So their operating income is now going to be $4650. Their total assets are $14,652. And now if we invest in the additional $4,000, now we're going to have $18,652. So our new ROI is going to be 24.93. Okay. So previously, Division 1's ROI was 25.94. So they're going to say, that's a bad deal. I'm going to lose some of my bonus. My ROI is going to go down. This manager is not going to want to take this project. Division 2, we know will want to take it because now Division 2 will have operating income of $26.84. The assets will go up to $13,678. And so the ROI for Division 2 is now going to be 19.62. So this brought them even closer to their target ROI because previously their ROI was 18.95. So this got them closer to the target. But Division 1 is going to say, hey, I don't want to do that deal. And the investors want them to do this deal. So this is why we should look at residual income. Under residual income, we take the operating income and we'll subtract the minimum acceptable income. And so the minimum acceptable income is that target rate of 20% times the investment in assets. And so when we look at that for the two divisions, we see Division 1 is 920 and Division 2 now is only a negative 52. We can see before it was 870 and negative 102. So both of these managers improved their residual income by taking on this project. So this would be a way to get Division 1, get the goal congruence between what the Division 1 wants, which is this manager wants to maximize his or her bonus, and the company wants to take on this project because it has at least a 20% return. So that's how you would be evaluating the manager of an investment center. The next thing we want to look at is transfer pricing. So this is when you have one division makes something that the other division uses. And this happens more and more frequently. We have what's called vertical integration, where companies will acquire their supplier or they'll acquire one of their largest customers. So that's what happens, is that one division is buying from another division. And so if the manager is being evaluated on their segment margin, they want to make the best deal possible, right, when they make a sale. If they can sell more to somebody, and a customer outside the company, they don't necessarily want to do this internal sale. So we have to find a price that is going to be advantageous for both managers. And so these are some different approaches that you could use. The company could just say we transferred at market price. We could say let's let the managers negotiate a price, or we'll have a policy that the transfer is done at cost or cost plus a markup. So a market price, when we have an outside market price, we could just say we'll sell it to you the same way as we would sell it to any other customer. So that's going to keep, the company that manufactures the product, that's going to keep them happy because they're coming out the same. Now, perhaps we can avoid marketing costs, distribution costs, so maybe we can even sell it less than if we were selling it to an outside customer. And so that might make a good deal for the division that needs to buy the product. Negotiating price is where the two managers can sit down and we can find a price that's going to be beneficial to both. However, sometimes we could have friction between the departments if one manager feels the other manager is getting a better deal. So when we're trying to determine what the selling price is, the selling division needs to at least cover their variable costs. This is assuming there's excess capacity. The fixed costs don't need to be taken into account if there's excess capacity. So anything that covers our variable costs, anything above the cost of the variable cost, is going to add to the operating income of the selling division. The buying division obviously won't pay more than the market price. They might as well go to an outside vendor if the selling division wants more than market. Cost or cost plus a market. So the company could have a policy. It could be cover the variable costs, or it could be full absorption costs where we even get the fixed costs covered, because that would, again, that would improve the operating income for the selling division if they were getting their fixed costs covered as well. Or perhaps there's just a certain percentage markup that's standard. And as long as that's below the market price that the buying division could pay if it went to another vendor, an outside vendor, then that's going to be beneficial for both division managers. The drawback to this, the selling division has no incentive to control costs. If we just have a blanket policy that it's costs are covered, then they don't need to control the costs. Something that come into play are global considerations. If we have different tax rates in different divisions, and sometimes the transfer price will be structured so that the operating income of the division in the lower taxed place is being increased. The last thing we look at in this chapter is going to be master and flexible budgets, and so let's look at that in the next video.